Hi. Beginner traders usually focus their attention on guessing the future of the market, the future trend, the future price direction, and so on. What if the most crucial point in trading is not the forecasting part? One of the most ignored topics, especially for beginners in trading, is lot sizing or trade sizing. How much can we risk on each trade? And can we make it trade dependent, meaning the size of the trade will change according to different conditions? This topic is highly related to risk management and consequently trade management as well. In this video, we will go through 3 different trade sizing approaches that we will explain, and I will show you how to backtest these approaches numerically in Python using historical data and an algorithmic trading strategy, just as an example. As usual, the Python code is available for download from the description below, so you can get the code and use it for your experiments. If you feel inspired, you can support this channel leaving a comment, sharing your ideas, or simply pressing the like button. The first sizing method uses a constant trade size. No matter the conditions and no matter the stop loss and take profit distances, we just stick to a fixed lot size for all the trades. This method is very simple and it's what most of beginner traders are using. But the problem is that it disregards every other component of your trading framework. It doesn't adjust according to equity in the account, how much money you still have in your account, and it doesn't consider any risk management. So sometimes we might be trading too little, and sometimes we might be trading too much, depending on how much money is in your account and what is the fixed lot size we are using. It's a good method to start with, but it won't take us far in trading. The second method sizes the lot based on the equity, meaning how much money is left in the account. It just takes a percentage of the equity and uses this amount for each trade. For example, if we intend to trade with 2% and we have $1,000 in our account, this means that we will be sizing our trade around $20. This method is better than the previous one because it allows us to adjust the trade amount depending on how much money is left in our trading account. And it has an advantage when it comes to winning strategies. It will continuously increase the trading size when the account amount is increasing. And our trading will benefit from a sort of compounding effect, leading to a faster growth. However, I have used this method in the past. It's relatively simple and fast to apply, and it doesn't require lots of calculations, but we also have used it previously in similar videos while we were backtesting some of our strategies. The third method is by far the most advanced, and it takes into account the risk-reward ratio, considering stop loss and take profit distances. To apply this method, first we need to know the exact entry position value, the price, but we will not open the trade yet. We will compute the stop loss distance according to our strategy, and we calculate this distance in pips unit. Again, we still didn't open the trade yet. We can do the same for the take profit distance, which might be optional depending on the strategy we are following. Then we compute the proportion of equity we are risking based on the stop loss distance, and we define the lot size accordingly. Let's consider a numerical example to simplify things and see how we do this in practice. On this chart, the price broke below a key level at some point, so we can see this here. Then it reacted upward, testing the same level twice, after which we had this strong bullish candle and a retest of the key level in the bullish perspective, so it's now acting as a support level. We also have these rejection patterns that are seen on the candles here. So this suggests that the price might be taking a bullish movement. The seller's power currently on the market is clearly seen in this green candle. It's a long candle, and their determination in those small consecutive rejection. So we will consider this candle our entry point in the long direction. The stop loss is at the previous swing low, and the take profit distance is twice as far as the stop loss. So we have a take profit stop loss ratio of 2. In this configuration, we are risking 12.5 pips. If I need to convert this pips risk distance into equivalent in currency, I will have to consider the trade size. The risk amount is equal to the lot size times the stop loss in pips times the pip value. In numbers, if we are trading 0.01 as a lot and the US dollar is almost 1.08, let's say euros, considering the 12.5 pips in risk, we would be risking $1.35 in this trade. Now, if my trading account contains a total of $100, this means we are risking 1.35% just for this trade. This is all good, but how can we leverage this information to define our lot sizing? First, we need to fix the risk percentage we are willing to apply in our trading. If you want to risk, let's say 2% of the total equity, the lot size will be equal to the risk amount, 2% of the total equity in this example, divided by the stop loss distance in pips times the pip value, which depends on the asset and the time we are trading. Now that we have all the components for our trade, we can execute the trade on the market using the calculated lot size. We still have one very important point to consider though. In some strategies, the take profit is defined by a set of rules that are independent from the stop loss distance. So we don't have this take profit stop loss ratio, which is 2 in this example. For example, instead of fixing the take profit as twice the stop loss distance, we will set the take profit as the previous key level, for example, at the previous key level above our entry position. In this case, we can't rely only on lot sizing. We have to consider a condition where the ratio between the take profit over stop loss distances is above a certain threshold, let's say between 1.5 and 2. So we're not fixing the ratio, we're fixing the stop loss and the take profit at the swing low, swing high, but we will not pass the trade unless the ratio between the take profit and stop loss is above 1.5 or 2, because we don't need to take a lot of risk for a small profit, right? So if the ratio doesn't meet this condition, we simply drop this trade and we wait for the formation of another pattern and another opportunity on the market. So if I had to summarize this method in few seconds, I would say just like we set conditions for entry indicators and trading triggers, and we wait for these patterns to form on the price charts, we have to do the same and set conditions for the trade management part as well to confirm the entry signal. If the conditions are not met, for example, the lot size is too small to cover for trading fees, or if the take profit stop loss ratio is not above a minimum threshold, then we simply drop the opportunity and we don't enter the market. In other words, we can have two indicators, the entry signal and the trade management signal. When both are satisfied, the market is ready for our trade. Now, we will go through the Python code, see how we can easily implement these three methods while backtesting our strategies. Just a reminder again, the Python code I will be using here is available for download from the link in the description of this video. Check the description, click the link and download it. You can experiment on this Jupyter notebook on your own. If you get somehow inspired by the code, by the video, let me know what you think in the comment section if you have new ideas and so on. So this is our Jupyter notebook file. I'm starting by reading the CSV file that we have. So this is our historical data. I'm going to share it as well in the description of the video so you can download it. I'm cleaning the data, so I'm not spending so much time here. Computing the RSI, the ATR, the Bollinger Bands, computing the Bollinger Band signal. I'm not spending a lot of time on the strategy itself and the signal itself because this is a strategy that we have used and explained in the previous videos. But the purpose of this video is to show you how we can use the lot sizing. So just to focus our time on the lot sizing and the backtesting part. This is another signal as well. So the RSI signal windowed here. In brief, actually, we're checking if we have, let's say, the last 5 RSI values above a certain threshold, which is 50.1 here, for example. In this case, we consider we are in an uptrend or a short uptrend at least. In the opposite case, if the RSI, the 5 RSI values, the last 5 RSI values are below 49.9, we consider we are in a downtrend. And we have the Bollinger Bands to detect extreme cases. So if the price closes below the lower Bollinger Band, we have a buying signal or a long signal. If it closes above the upper Bollinger Band, we have a short signal. Obviously, we have to combine these two signals. So if we are in an uptrend and the price closes below the lower Bollinger Band, we have a bullish signal. In the opposite case, we have a bearish signal. So I'm checking how many signals I have in my data. We have 362 long signals, 305 short signals. Then we can plot these. So I'm plotting the signals here on this chart. This is just a small slice of our data. So I'm taking between 100 index and 350. So 250 candles. And we can see we have a signal here. This is the purple point. That's a long signal. It's a good one. It's going up and we close below the Bollinger Band and we can see that the price continued up. This one is also a good signal. So it's a long signal as well. So actually it's not bad as a strategy, but the strategy is not the focus point of this video. I just want to focus on the lot sizing. The first method is the fixed lot size. So when we're using backtesting, I'm using backtesting library or a package to backtest the strategies. Using just a slice of our data frame, we define the signal function for which we provide where the signal is. So that's called total signal from our data frame. That's a column that we have added to our data frame. That's df total signal. It takes into account both the Bollinger Band and the RSI signals at the same time. So this is our total signal. And this is what this function does. It just returns the total signal for the current candle. And then we have this my strategy that inherits from strategy from the backtesting package. If it's the first time you're using this package, it's a good package to backtest strategies on historical data. I'm passing the signal in the constructor. So in the init function, then we have the next function here. And this is where we pass our trades up to here. So if the signal is bullish is equal to 2, and we don't have any open trades on the market. So the length of the current number of trades is equal to 0. In this case, we pass a buying position with a stop loss value and take profit value and some size, let's say. So this is the stop loss, this is the take profit, and we're going to talk about this in a while. And in the opposite case, if we have a bearish signal and we don't have any open trades on the market, we define our stop loss and take profit distances and we pass a selling position. So this is our class. This is all what it takes. Now, regarding the lot sizing, notice that I defined a variable here called my size that's equal to 3000. 3000 is a fixed lot size. Remember, you have to divide this by 100,000 if you're using Forex. As a standard lots, when you trade using MetaTrader, when you trade one, you're trading 100,000 actually. So if you're trading 3000 and you divide it by 100,000, that's 0.03 equivalent on the MetaTrader if you're used to using MetaTrader. So this is what 3000 is here. I'm going to put this in comments so it might be easier. So MetaTrader for 0.03 lot. Okay, so this is a fixed lot size. It's not going to change. Any trade that we're passing here has the same size. So it's self.mySize. It's equal to 3000 for the long positions and the short positions as well. And now we can simply backtest. So BT is equal to backtest, the data frame where the data is present. So I took a small slice to make it quicker. My strategy. So this is the class. How much cash do I have? So 250, and the margin, which is the leverage. So 1 to 30. And then we optimize this. I'm optimizing only the take profit stop loss ratio and the stop loss coefficient. So the distances of stop loss and take profits. And we can run this. We can see the results here. We have results of 12% in returns. And the Sharpe ratio of 1.71. So Sortino ratio of 9.8 and so on. So we have all of these ratios. And this is how it's done, basically. So this is in the best case scenario. Remember that we've optimized the strategies. We've optimized the take profit and stop loss distances to get the best outcome. We can still print actually these two parameters using the stats_strategy here. So this is how we can guess that the best parameters are obtained for 1.1 as a stop loss coefficient and take profit stop loss ratio of 1.1. We can plot this, we plot the heat map, and we can see that it's here, taking into account the different take profit stop loss ratios and the stop loss coefficients, and these are the returns. So this is how you can take into account a fixed lot size. So it's very simple. Now, to our second example, if we need to get an equity percentage lot or trade size, we have to insert a number that's smaller than 1, so it's less than 1. When we use a number or a lot size that's smaller than 1, automatically backtesting package will consider this as a percentage of the equity. So here 0.3 is actually 30%. So 30% of my equity is going to be used to buy as a trade size. Now, I'm not going through the whole set of details here because it's basically a copy paste from the previous one. So it's exactly the same as before. We just changed the my size or the size of the trade to a value that's less than 1. Now we can go on. If you are curious about the results, notice that we have 8.8% for the same period of time. Let me check how much do we have here. We have 12% in this case. And the Sharpe ratio used to be 1.7. In this case, it's 2.0. So we have a bit less returns, but a better Sharpe ratio, because obviously if we adapt our trading to how much money we have in the account or the equity, we're going to decrease this amount when we have less money, and therefore the risk is going to decrease as well. So previously we had more returns, but we were risking a bit more in our trading. Okay, now to the third and the most interesting one, actually, where we will be taking the risk in consideration to define our lot or trade size. In this third method, we're going to define a new variable called risk percentage. And I'm going to put it 0.02. And that's going to be the percentage of risk I want to take for each trade from my equity. So that's 2% of my equity. But we consider the stop loss distance. So it's not 2% of the equity that's going to be fully invested in the trade. It's going to be 2% considering the stop loss distance. Let me show you how we can do this. So we have obviously the stop loss coefficient, the take profit stop loss ratio, and so on. So this is the part where we define this. So the lot sizing considering the risks you want to take. We're going to use the formula that we've explained at the beginning of this video. The pip value is equal to 10 to minus 4 divided by the current closing price, the current price of the asset, times 10 to 5. So 100,000 lots, because this is the standard in Forex. If you're not familiar with these values, let me know in the comment section. I can make a video on how it's computed and how things are calculated in the Forex and the stock market. So anyway, we need to multiply by 10 to 5. The ratio between 10 to minus 4, that's the precision. That's 1 pip, actually, depending on the broker you are using. But it's usually a standard 10 to minus 4 using Forex, divided by the current price. So we need the current price for each pip. And then we can use this formula to compute the size of the lot. So the size is equal to the risk percentage times the equity. So how much money I'm willing to put on the table. That's 2% in this case times the equity, how much money I have in my account. I'm risking 2% of my equity considering the stop loss ATR distance times the pip value. We called it stop loss ATR because it's ATR related. So we're fixing the stop loss distance as a coefficient times the ATR value of the current price. So this is why we called it stop loss ATR. It's basically the stop loss distance. So how far is the stop loss from the current entry position? And we're going to multiply this by the pip value, because we're going to transform the stop loss distance from pips unit to pip value unit, in other words, to currency units. And this is how we can get the size of the lot. And this is the size that we're going to use. I have to cast it into an integer, because when you have a float here from the division, it's not accepted as a size of a trade. And we have a perfect size that takes into account the risk that we are willing to put on the table. So notice that you can change this to 2%, 3%, 50%, 100%. It depends how risky you want to get. Usually, as a rule of thumb, a lot of books, a lot of professional traders, they use something between 1 to 2%. I personally used 5% because I'm usually impatient, but we're going to try these and I will show you how it influences the results. So let's run this backtest. And there we go. So we have a return of 3.7% and a Sharpe ratio of 3.5. That's not bad, actually. This is a very good Sharpe ratio. Notice that the Sharpe ratio will be decreasing if we increase the risk. So let's say if I want to risk 3% instead of 2%, I run this again, I'll run it again. But at the same time, we're going to increase our returns probably. So if it's a winning strategy, let's check what we will get with 3% instead of 2% in risk. And here we go. So we have 5.5% in risk. We were around 3% previously, but the Sharpe ratio is now 3.25 instead of 3.5. So as you can see, we increase the risk, we're going to decrease the Sharpe ratio. Sharpe ratio doesn't like risk. And at the same time, we're going to increase our returns. And it's up to us to find this balanced risk that we're going to use. I personally use 5%. You don't have to follow my trading. Just don't listen to me. I'm impatient. I'm kind of aggressive in trading. Using 5%, we get 8.7% in returns and a Sharpe ratio of 2.6. So we're still kind of safe. I would say a Sharpe ratio of 2.6 is okay. 8% is okay as well because the duration is 34 days. So remember, we took just a slice of the data frame. We're not trading over years here. So that's around 8% per month. Let me check. The number of trades is 52. That's a high number of trades. So commissions might eat almost half of this. So you're around 3% per month or 4% per month. If you haven't switched to this kind of trading, I highly advise you, whether you're trading manually or algorithmically. In both cases, this approach, the third approach where you define the lot size or the trade size based on the risk percentage, is very important to get used to, because this is much better than the two previous methods. And out of experience, I could tell you that only this might make a big difference in your trading returns. And this was it for this video. Let me know what you think in the comments section. If you have any ideas, please don't refrain from sharing these with us. Until our next one, trade safe and see you next time.